Welcome to Market Matters, our markets podcast on making sense, the hub for JP Morgan Corporate and Investment Bank podcasts. In each episode of Market Matters, we discuss the latest news and trends shaping markets today.
We have spent a lot of time over the last 20 years working with a number of academic advisors, experts in financial statement analysis, to see how we can systematize a lot of the fundamental analysis that a traditional discretionary manager would be doing on a company. These days, our models consume around 40 million data points every day to help us analyze the 7,000 stocks. To be honest, we think there is maybe more hype than actual alpha in AI when it comes to stock picking, running equity portfolios. Clearly, in some industries, like the more creative industries, Gen AI has very tangible benefits. But when it comes to financial markets suffer from a lot of noise.
Hi, I'm Eloise Goulder, head of the Data Assets and Alpha Group here at JP Morgan. And today I'm so pleased to be here in the Jupiter offices with Dr Amadeo Alentorn, who is head of Systematic Equities at Jupiter Asset Management, and who has been involved in systematic equities and in building a systematic equity engine over the last 20 years. So, Amadeo, thank you so much for sitting down with me today.
Hi, Eloise. Thanks for having me in your program. It's my pleasure to be here.
So, Amadeo, could you start by introducing yourself and your background?
Yeah, sure. So, I started my career in robotics. I am from Spain, grew up near Barcelona, and I came here to the UK to do my undergraduate degree in robotics engineering. That was in the late 90s. And from there, I then went off to the US and worked for a robotics company, which was interesting, but the reality of working in robotics back then was quite far away from the sci-fi movies that I grew up watching. So from there on, I pivoted towards software development. So I went back to university, studied a master's in computer science and artificial intelligence. And then I worked as a software developer outside finance for some time. And then went back to university one more time and then studied a PhD in computational finance at the University of Essex. Interestingly, at Essex, they had this program where they were blending computational methods with financial applications. So I specialized in option pricing using extreme value theory distributions. And that's what really provided the bridge for me to move from an engineering technical background to then coming into finance.
Thank you so much, Amadeo. I mean, such an impressive background spanning robotics with computer science, with finance. And this was all those years ago. I mean, it must be really gratifying for you to see that these topics are so in vogue and so critical to finance today.
Yes, absolutely. So when I joined the team that I'm still part of today, about 20 years ago, my idea was to say, look, how can I use those very cool techniques that we were using back then to program robotic applications for autonomous robots, applying machine vision. A number of the AI techniques that, are very popular today have actually been around for a long time. And outside finance, those have been very successfully applied, to deal with some of the problems that we have in engineering, computer science. So yeah, it's been a very interesting journey.
So can you tell us a bit about how you then went on to enter the finance industry and the systems you've developed over the last 20 years?
So as I was finishing my PhD, I spent some time at the Bank of England developing simulation models for the Financial Stability Group, modeling the UK banking network and how stress scenarios would cascade throughout the banking system. So that was kind of my first kind of real world application to finance. And then from those early days, starting in 2005 at Old Mutual, we continued to develop those models. Eventually, we spun out of Old Mutual. We created Merian Global Investors, an independent asset management boutique. And 4 years ago, with the Jupiter acquisition of Merian, that's how we are now part of the Jupiter platform. So while there have been a couple of changes to our name as a team and the name of our funds, we've effectively been working in the systematic approach to investing in equity markets as a team for about 20 years now.
It's incredible to have that consistency in terms of personnel and, I guess, importantly, the engine and the tech infrastructure that you're using throughout those 20 years.
Yeah, so what's really useful for us as a team is to really have had the continuation of thought as a team as we had gone through the challenging environment of August 2007 with the quantmare, then the great financial crisis, then following the second tech bubble and what happened in 2022. So all of those experiences as a team, as we've been looking very closely at how the models are capturing those different market environments, it's very useful then to come up with research ideas to say, okay, how can we learn as a team and then systematically look at ways of improving the model so that if such environments repeat themselves in the future, we are better able to navigate those more challenging environments.
So can we come to the present and come to your current strategy? And can you tell us about what exactly you're running?
So the culmination of these 20 years of research have resulted in the current investment process, which from a structural perspective, you would describe it as a multi-factor model, where we have a number of different factors that are helping us to rank or score thousands of stocks daily. We have an investable universe covering the 7,000 largest, most liquid stocks in global equity markets, including both developed markets as well as some liquid emerging markets. And then looking at a very wide range of factors or ideas, going from more traditional long-term fundamental factors to shorter-term sentiment-driven metrics as well as price-driven indicators. The idea here is to analyze each and every one of those 7,000 stocks every day using lots of different data points. These days, our models consume around 40 million data points every day to help us analyze the 7,000 stocks. Some of those data points clearly would be traditional data sets, such as, what is the balance sheet of a company looks like? What is the cash flow statement? But then increasingly, we've been incorporating more alternative type data sets that help us better capture short-term sentiment in markets, benefiting from advances in text-driven signals, capturing the behavior of market participants through tracking things like flows, which can have a very big impact to prices in stock markets, especially in environments that are more sentiment-driven, where prices would typically tend to deviate significantly from their fundamental value if there's a lot of very strong sentiment in markets. So it's really about looking at a very wide range of ideas, of factors, of data sets that then, when used together, help us to systematically build these portfolios. Our flagship strategy is a global equity market neutral strategy, where for $100 of your investment, we would buy $100 worth of stocks that our model finds attractive, that score attractively across a number of different criteria. At the same time, we build a short book, short selling $100 of other stocks that score negatively across a number of criteria. And therefore, with this equity market neutral strategy, we can completely remove the risk of market direction without having any direct impact from the direction of markets.
Thank you, Amadeo. Well, I wanted to ask what your edge is and what your differentiating factor is. And what I'm really hearing is breadth. Breadth in terms of the number of stocks you cover. I think you said you're looking at 7,000 stocks. You're looking at developed markets and emerging markets, and breadth in terms of the number of data sets and the types of signals you're looking at. Would you say that breadth is your main source of edge?
It's a combination of many dimensions. Also, the breadth of stocks that we can analyze every day compared to maybe a more traditional fundamental approach really provides a lot of value. The global reach that we have obviously helps to diversify the strategy as well, because what we often see is our models are tracking investor behavior, how in different regions you have investors behaving differently. So then that's a source of diversification. And then finally, one aspect that we've spent a lot of time working on is this idea that there is no single style of investing that works consistently over a full cycle. If you look at the evidence over a full cycle, what you can see is that there are points in a cycle where some of those styles of investing can do very well. Other times they will do less well. So something that we've been using now for 15 years is a dynamic weighting scheme across styles. And over many years, what this allows us to do is to provide much more consistency in terms of outcome. For example, if you think about value strategies, Typically, a value manager will be looking to buy cheap stocks. But we know that there are points in the cycle where investors, when faced by fear, they would be happy to pay very expensive prices to hold on to higher quality or quality growth stocks as a more defensive holding, even though they have to pay higher prices for that scarce quality or scarce growth. And in those environments, clearly cheap stocks not only stay cheap, but usually get cheaper as investors are exhibiting that flight to quality behavior. It's a very human trait, the kind of the fight versus flight. And we see a lot of that behavior comes as behavioral biases in markets, repeating time and time again. So a dynamic weighting scheme around investment styles is very useful for helping us to navigate this dynamic. Rather than looking at style inflection points as an issue, for us it's a source of alpha, it's an alpha opportunity.
That's fascinating that you see factor timing as a source of alpha, because I think so many historically would disagree with you or would be cynical that factor timing really is possible. I mean, do you face that cynicism when you discuss with investors?
Absolutely. And this is the great thing about our industry, that there is space for everyone and it makes for a great ecosystem. And this in particular is a very heated topic, both in academic circles as well as industry circles. Some industry players strongly believing that you cannot time factors, that it's impossible. We've been doing this for 15 years very successfully, and it just helps to give us a different way of managing money and just gives us differentiation to asset allocators. Having access to different managers that have very different beliefs also offers them the opportunity of diversifying how they are allocating their capital and exploiting different ways of generating alpha.
That's so interesting. And generally over the last decade, growth has been such a strong factor. I imagine it's really helped you if your models have tilted you towards growth over that period. Out of interest, what are your models telling you today? I mean, value's had a decent run over the last couple of months. Are your models overweight value or growth or some other factor right now?
So if we're looking across the entire model, the area that is currently more overweighted is the sentiment family of factors. It's the part of the model that recognizes that in environments when there is a lot of uncertainty, currently we're facing lots of uncertainty from geopolitical events, macroeconomic, what the Fed is going to do with rates, inflation, and so on. So lots of different independent sources of uncertainty, which when you look at the equity market, shows up as an environment that there's a very high level of dispersion. And then what our models are able to do is they recognize that environment. They travel back in time, identify historic periods that were similar, and then ask a number of questions. Which styles of investing were more successful in those similar environments where there was a lot of uncertainty, a lot of optimism, valuations being reasonably stretched. And then what the models find is that short-term sentiment signals can be very useful for navigating those environments, while fundamental signals are still going to be part of the model, but less weight than sentiment.
Yeah, absolutely. So coming to your huge number of data sets that you look into, you mentioned that you take account of fundamental data, sentiment data, technical data. First of all, and you may not be able to answer this question, but which type of data do you deem more significant or more important?
Yeah, to be honest, there's no silver bullet. So there is no single data set that say, look, this is really key in us, getting the stock picks right. It's really about building this very complex puzzle for each of the companies to say, what are all the various drivers that are going to be influencing the potential returns for this stock? And where we find a lot of value is in finding those stocks that are scoring well across the vast majority of our indicators. So, typically there will be stocks that from a valuation perspective, they look attractive. They've got strong balance sheets. They've got a stable growth profile historically that can be expected to continue into the future. Then where the various sentiment metrics, which are more short-term in nature, are supportive. Company management, many indicators tracking the quality of the management team systematically. What has been their cash discipline, the use or misuse of external financing, decisions around growth, internal growth through innovation versus expensive inorganic acquisitions, for example, alignment of managers with investors, looking at things like directors' deals, how a management team is dealing with ESG risks, also an important aspect, a number of price-driven signals. So there's not really a single data set or a single fact I would say, look, this is really, really important. It's more about finding that alignment of which companies score well across a number of different factors. And then when the model makes a trade and buys or shorts that stock, it does so for a number of different reasons. And therefore, that de-risks very significantly that trade. And that is what results in maybe a higher hit ratio of our positions relative to another strategy that's maybe more unidimensional, that's just focusing on exploiting one single idea or one single data set.
That's a really interesting way of putting it, that by ticking so many different boxes, you have de-risked the investment decision, de-risked the trade. Thank you for explaining that. Coming back to your process, you obviously have incredible fundamental knowledge around equities and around the stocks you're investing in, but also you're leveraging all of the data science techniques that harks all the way back to your academic background. How do you think about the intersection between the two? Where do you lie on the spectrum of importance of fundamental domain knowledge versus quantitative technical skills?
Yeah, I think it's about finding a happy medium in between those two extremes. And obviously, if you look at the industries, you would see some managers focusing more on the machine learning, computer science side, others that would focus more on very deep fundamental analysis. We see ourselves as being in the middle of those two extremes, where on one hand, we have spent a lot of time over the last 20 years working with a number of academic advisors, experts in financial statement analysis, to see how we can systematize a lot of the fundamental analysis that a traditional discretionary manager would be doing on a company. So there's definitely a very heavy emphasis on that. Conceptually, when you look at a company, fundamentally, how do we capture those attractive attributes? But then, obviously, for other parts of the model, very important to have the technical skills to be dealing with some of these very large, complex data sets. And that's where a lot of the computer science, artificial intelligence type techniques, advanced econometrics can be very useful and are necessary in terms of actually building models that capture those aspects. This is more relevant in particular for the shorter term factors. Another way in which we look to diversify our stock picks is by also blending a number of different horizons. So clearly some of the factors will be longer term nature, some will be shorter term. And again, by blending all these different horizons, it's also a way of de-risking that decision.
And do you tend to be hypothesis driven? Do you have a domain knowledge based prior before investing, or do you throw everything at the wall and look at what sticks and what works?
Yeah, I mean, that's a big part of our DNA as a team, that we are always starting with a hypothesis. And we would typically spend, a significant amount of time discussing within the team, discussing with our academic advisors. Here at Jupiter, we can also draw from the experience of our colleagues in the fundamental desks, different asset classes, to say, look, if we have this idea of how we can make money, conceptually, why is that? Are we exploiting a mispricing? Or do we have an information advantage? Or do we have another kind of edge that explains why we can expect to extract alpha from a given idea? Because as we know, alpha is hard. It's very hard to wake up one day after having done this for 20 years and think of something that's an amazing idea that no one else has thought about, right? Markets are not efficient, but they're pretty efficient. And therefore, you really need, as a team, we really need to spend a lot of time convincing ourselves that an idea makes sense conceptually. And then we would go through a number of steps to actually testing empirically whether this idea would have worked historically. That actually involves a number of different tests. First of all, we're starting with that idea independently and saying, okay, could we generate alpha if we were to use that idea on its own right across different regions, across time, across sectors? If that is the case, then the next question is to say, if we add this new factor, this new data set, this new idea into the existing model, is it making the model better? Obviously, that's quite a high hurdle because having developed this model for almost 20 years now, it's difficult to come up with brand new ideas that would completely transform the forecasting power of the model. And when we're saying making the model better, there are a number of different dimensions. Is it improving returns? Is it reducing risk? Is it improving diversification?
Yeah.
It's not just about returns. Is it improving the consistency of the overall model over time, being less dependent on particular market states? So we're very interested in seeing how can we find diversifying factors that help us navigate more difficult market environments in particular.
Absolutely. I always ask our guests, what's more important, the data or the model? I'm sure you're going to argue that both are important, given your data-driven and model-driven approach. But what's your thoughts on this?
Yeah, so my answer would be actually that more than data or models, what's most important is the hypothesis, going back to this idea of really having a very solid grasp of the conceptual idea that you're trying to implement here.
Interesting.
And then obviously, clearly, you need high quality data that you can rely on to implement that idea. And then modeling techniques are obviously very important. Over time, we have had to accept that, for example, for some newer data sets, maybe the history is not as long as we would have liked. Some of the newer data sets, you cannot really go, several decades back in time to test those ideas. So you have to compromise on the length of time that you have. Other data sets, maybe they don't have as much coverage as you would like, because maybe they are only relevant for a given sector or industry or region. So when we're talking about the quality of data, there are many different dimensions. The best case scenario is that you have a very long data set that covers all the stocks, all the regions, but the reality is that as you start to look at more alternative type data, you need to be more creative on how you fill those gaps. The modeling approaches also are important, especially when you're dealing with data that might be more prone to outliers. So having a very robust modeling approach that if the data is of slightly lower quality, it can still deal with that data and still extract insights without outliers impacting significantly the outcome. So yeah, I'm probably dodging your actual question, but hypothesis, data, and models, the three are really important. And in conjunction, that's what we are focused on delivering.
Well, I haven't had that answer yet, hypothesis being the most important one, although many of your colleagues have highlighted the need to have a hypothesis, to have that domain knowledge in the first place. So final question on the data and the model before we move on. Machine learning and AI. I'm sure you have a lot of experience in this space. You've mentioned that you're leveraging textual data, NLP, I assume. How much do you use machine learning and AI?
So for me, at the personal level, it's been a very interesting journey because as I was saying, starting my life as a robotics engineer in the 90s, I was already working with AI techniques back then. Clearly, we've all seen an explosion of AI being popularized by things like ChatGPT, Gen AI. And to be honest, we think there is maybe more hype than actual alpha in AI when it comes to stock picking, running equity portfolios. Clearly, in some industries, like the more creative industries, Gen AI has very tangible benefits. But when it comes to financial markets suffer from a lot of noise.
Yeah.
And even though we think that we have a lot of data, when it comes to things like factor timing, you look back through the history of markets, you look back at 20, 30, 40 years, and you actually have very few unique data points. You had the dot-com bubble, which bursted, then you had the credit bubble, then you had the tech rally in more recent years. So in terms of unique data points for those key decisions that asset allocators are facing, in terms of, what kind of equities do we want to be allocated to it? Something that we can solve with our dynamic weighting scheme. For those types of decisions, you actually don't have so many unique data points. So you need to be very conscious of that. And again, that's why starting with a very strong conceptual understanding and grasp of what you're doing is very important. And in those aspects, actually, AI can be very dangerous because you can use a very complex model that doesn't have a lot of underlying unique data points. And yes, the model will give you some answers, but how much can you rely on those answers is only going to be as good as the data inputs. Clearly, for other strategies like high-frequency trading, where you're effectively trading tick by tick, you do have lots of data and lots of unique data points to extrapolate how short-term microstructure in the market is repeating itself as a pattern, and then you can extract through AI, maybe through more black box kind of machine learning tools, some trading strategies that might have a higher degree of confidence in working because you end up with more data points. But yes, within AI, we have been successful at integrating a number of AI tools as investment process. Text is definitely an area that has been very productive for us. Historically, we were only relying on numeric data. As natural language processing, NLP techniques have improved, we have been able to incorporate now for a number of years things like the analysis of earnings transcripts, so trying to extract signals from what management is saying in those quarterly earnings calls, not just in terms of what they're saying, but how they are saying it. There's a lot of information in the structure of the language being used, in the Q&A sections of those transcripts, analyzing news. That's another source of information. In terms of dynamic timing of factors, the models that we use are very flexible. You could consider them as a form of machine learning, but where, again, there's a very strong conceptual framework around what we are expecting the models to do.
Yes.
So definitely some incorporation of AI within the models, but overall, I would say that for investing, for stock selection, I would say more hype than actual alpha these days.
Very interesting to hear that. Well, I think this is a great time to wrap up part 1. So we'll pause the conversation now and we'll be back in part 2, where we'll really dive into the competitive landscape and the competitive dynamics in this systematic investing space. So Amadeo, thank you so much.
It's been a pleasure. Thank you.
Thank you also to our listeners for tuning into this bi-weekly podcast series from our group. If you'd like to learn more about Amadeo's work and Jupiter Asset Management, then please do see the show notes. Otherwise, if you have feedback or if you'd like to get in touch, then please do go to our website at jpmorgan.com/market-data-intelligence, where you can reach out via the Contact Us form. And with that, we'll close. Thank you.
Thanks for listening to Market Matters. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. Reflect the views of JP Morgan Chase & Co. and its affiliates, together JP Morgan. They are not the product of a recommendation, advice, or an offer or a solicitation. It is intended for institutional and professional investors only and is not intended for retail investor use. It is provided for information purposes only. Referenced products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. JP Morgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com/disclosures/sales and trading disclaimer. For the avoidance of doubt, opinions expressed by any external speakers are the personal views of those speakers and do not represent the views of JP Morgan.